If you only glanced at the S&P 500 today, finishing down just under 1%, you would probably think it was a fairly quiet, slightly red Monday in the summer. You might have even turned off your screens early. But underneath that incredibly calm surface, today was actually one of the most violent, dramatic, and revealing days we have seen in the markets in months. It was an absolute rip current hiding beneath a glassy ocean.
It really was a wild session if you knew where to look. We had a full-blown, historic stock market crash in South Korea that triggered their 7th circuit breaker of the year. We had the single most crowded trade on the entire planet, memory chips and semiconductors, getting absolutely shredded in real time. And to top it off, we had a massive geopolitical shock with the Strait of Hormuz effectively closed, sending oil spiking violently.
It felt very much like a tale of two markets today. On one hand, everything looked completely orderly and contained at the very top index level. On the other hand, you had these massive, high-speed unwinds happening in specific, highly leveraged pockets of the market.
Exactly right. And the central question we have to answer today, the whole puzzle for investors to figure out, is whether what we just saw was a fundamental break in demand for things like artificial intelligence and memory, or if it was just a massive, mechanical unwind of leverage. Spoiler alert for the rest of the episode, all the hard evidence points directly to a leverage unwind, not a change in the actual business fundamentals. Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research.
Let us run through the actual numbers first, because the daily scoreboard really tells that story of an orderly surface masking a violent underbelly. The Dow Jones Industrial Average slipped just 0.26%, closing around 52,499. The S&P 500 fell 0.79% to finish at 7,515.
The Nasdaq took a slightly harder hit, as you might expect on a tech-heavy day, dropping 1.55% to 25,873. And the Russell 2000, which tracks smaller companies, fell 0.83%. So looking at those major indexes, you really would not think panic. It looks like a standard, everyday pullback. Nothing seems broken.
But then you look over at the VIX, the market's primary fear gauge. The VIX jumped over 14% today to hit about 17. That is a highly significant spike in implied volatility for a day where the S&P 500 did not even manage to drop a full 1%.
That VIX spike is your absolute tell. It shows that underneath the major averages, big institutional traders were scrambling to buy downside protection. The surface was totally orderly, but the cross-currents happening underneath were incredibly intense. It was a day characterized by forced selling and sudden illiquidity in certain pockets, not just people deciding to take a little bit of profit off the top.
The absolute epicenter of the pain in the U.S. today was the semiconductor sector. The broad semis ETF, the SMH, fell 4.16%, and the Philadelphia Semiconductor Index dropped a painful 4.8%. But when you look at the individual memory and storage names, it was a total bloodbath.
Annihilated is really the only appropriate word for what happened to memory today. SanDisk was down 12.6%. Marvell dropped 7.8%, and ARM was down 7.6%. Seagate fell 5.5%. Western Digital dropped 4.6%, and Micron was down 4.3%. Even the vital equipment makers got dragged down hard, with Lam Research falling 5.8% and Applied Materials dropping 4.5%.
It is wild to see those kinds of deep red numbers in a single day for companies that are supposedly the picks and shovels of the entire artificial intelligence revolution. Why was the pain so aggressively concentrated in that specific area?
Because it was overwhelmingly the most crowded trade in the market. Everyone was piled into memory and chips, and crucially, they were often doing it using borrowed money. When you have an incredibly crowded trade built on margin and a sudden shock hits the financial system, those are the exact names that get sold first. People do not sell them because they suddenly hate the companies. They sell them because they have to meet a margin call. The most crowded trade took the absolute most pain.
That brings us to where this whole cascade actually started today. It began overseas, and the numbers are just brutal. South Korea's KOSPI index crashed 8.95%, closing near 6,807. That breaks well below the psychological 7,000 level, and it triggered the market's seventh circuit breaker of 2026.
It is genuinely incredible to watch. The KOSPI is now down about 27% from its recent high, and SK Hynix, which is a global memory giant and a completely massive weight in that Korean index, plunged over 15% in a single session.
What actually happened mechanically over there? Why did a major developed market drop so fast and so hard that they had to halt trading?
It was a textbook, cascading margin call. Banks over in Korea started tightening their margin requirements. When that happens, hundreds of thousands of highly leveraged retail accounts suddenly get caught off guard. They do not have the extra cash lying around to meet the call, so the brokers force-liquidate their positions to protect the bank. The stocks are sold out automatically at whatever the market price is, and many of those retail accounts go straight to zero. That automatic selling triggers lower prices, which triggers more margin calls, and suddenly you get a full-blown crash.
This is the crucial distinction we need to make for anyone trying to make sense of today. When people see a giant like SK Hynix down more than 15%, they immediately ask the scary question, is the artificial intelligence trade over? Is memory demand suddenly cracking?
And the answer to that is no. This is absolutely not a break in real-world demand. Look at the actual fundamental numbers we just got. SK Hynix reported their quarterly operating profit, and it was up more than fivefold year over year. That is a staggering record profit. It came in just modestly below some very lofty whisper expectations. But fundamentally, it is a massive, incredibly healthy number.
We also saw Taiwan Semiconductors' monthly sales coming up 36%. So the foundries are still selling these advanced chips literally as fast as they can manufacture them.
Exactly. Now we have to stay a little humble here. We obviously cannot be certain about what the future holds, but all the available evidence points to a mechanical washout. The selling today was forced by margin calls and algorithms, not driven by a change in the fundamental business story. We are looking at a positioning and leverage issue, not a fundamentals issue.
As if the Korean margin call was not enough for one Monday, the second massive blow today came from geopolitics. Iran officially closed the Strait of Hormuz, which is widely considered the world's most important oil transit choke point.
In direct response, the United States announced a blockade of Iranian ports and introduced a transit fee on any oil moving through the strait. The market reaction was violent and immediate. Oil spiked about 9%, with WTI crude jumping up to around $78 a barrel.
That is a massive, incredibly disruptive move for energy markets in a single session. And it comes at a very sensitive time for the global macroeconomy.
It injects a fresh, intense inflation shock right into the system at the absolute worst possible moment. We are waiting on key consumer price index data, and suddenly energy prices are shooting up. It forces every trader and institution on Wall Street to completely reevaluate their inflation models for the next several months.
What made today so unusual and revealing to me was the cross-asset reaction. Normally, on a scary risk-off day where a foreign market crashes and there is a major geopolitical crisis in the Middle East, you expect gold to rise as the ultimate safe haven.
But today, oil jumped 9%, and gold actually fell about 2.3%. At the exact same time, the US dollar rose and bond yields rose, with the 10-year Treasury yield climbing to 4.61%.
Rising oil, falling gold, and rising bond yields. That does not look like a clean, traditional flight to safety at all.
No, it is the exact fingerprint of a leverage unwind with a very specific stagflation twist. Gold fell because leveraged players were getting margin called, and they had to sell whatever liquid assets they could to raise cash, which included dumping their gold. And the rising yields combined with rising oil signal that the market is suddenly worried about inflation staying higher for longer, which stifles economic growth. It was a stagflation-tinged, forced selling risk-off day, not a simple flight to safety.
If we zoom out and look at the broader U.S. sectors, it really was not wholesale panic across the board. It looked much more like a massive, high-speed rotation.
Right. The winners today were energy, which was up about 3% on that geopolitical oil spike. Utilities were up 0.7%, catching both a defensive safe haven bid and an ongoing power demand bid. And financials rose 0.65%, as investors positioned ahead of the major bank earnings kicking off.
The losers, obviously, were the highly crowded growth trades, semiconductors, broad tech, and consumer discretionary. But tellingly, software, which we track with the IGV ETF, actually rose slightly today.
That is a massively important data point. Software did not participate in the sell-off at all. That tells you definitively that this was not an all-tech collapse or a rejection of technology broadly. People were rotating out of the hyper-crowded, over-leveraged chip trade and moving that money into software, financials, and energy. It was a chips to software rotation happening just underneath the surface.
I want to take a moment here because days exactly like today offer a really profound, practical lesson about risk management. U.S. margin debt is currently sitting at a record $1.42 trillion. That is up almost 54% year over year. The entire financial system is more leveraged right now than it has ever been.
And Korea just showed us exactly what happens when a tiny corner of that massive leverage snaps. Today is a live, deeply painful example that being right about a macro trend is simply not enough. Those Korean retail traders who bought memory stocks were fundamentally right. Artificial intelligence demand is very real, and SK Hynix just posted record profits to prove it.
But despite being right about the thesis, they still got margin called to zero. They will not be around to see the thesis they believed in actually pay off in the long run.
That is the ultimate trap of leverage. If you were too aggressive, a random shock you never predicted, like a sudden margin call in Korea or an oil spike out of nowhere, can completely take you out of the game before you are ever proven right. The single most underrated skill in all of investing is simply surviving long enough to be right. You have to size your risk so that no single surprise can end you. Stay a little humble out there, because the market can stay irrational longer than you expect, and leverage entirely removes your ability to wait it out.
There is another, slower burning risk lurking under all this that we need to talk about. Who is actually funding this massive artificial intelligence boom?
Right. It is the corporate debt market. 6 AI giants, Amazon, Alphabet, Meta, Oracle, Nvidia, and SpaceX, have issued a record roughly $244 billion of high-grade bonds in the first half of this year alone. To put that massive number in perspective, they issued about $108 billion in all of last year combined.
That is an enormous, breathtaking acceleration in corporate borrowing. And investors are actually starting to push back a little bit. Amazon's latest bond deal reportedly got a very cold reception, and Oracle stock fell 6.5% today.
The bare worry here is that this massive infrastructure build-out is increasingly being debt-financed, and the bond market is finally beginning to test its limits. If the cost of borrowing for these tech giants goes up, or demand for their debt wanes, it could seriously slow down the pace of the entire AI infrastructure build-out.
Now let us add the compounding risk of the Federal Reserve into this mix. We had a Fed official, Governor Waller, signal today that a strong core inflation reading tomorrow would actually justify a near-term rate hike, rather than the rate cut everyone has been waiting for.
And the bond market repriced that extremely fast today. The odds of a July rate hike jumped from about 34% to 43% in a matter of hours. And the odds for a September hike are now sitting above 70%.
Plus, we have the huge oil spike today, which is inherently inflationary. So it is pouring absolute fuel on exactly the fire the Fed is most worried about.
Right, and it happens right as the crucial inflation data is about to land tomorrow morning. The Fed is desperately looking for reasons to be cautious, and a massive spike in energy costs gives the hawkish members all the ammunition they need to keep rates higher or even push them further up.
Looking at the broader global picture, Korea was clearly the epicenter of the pain today, but the contagion was surprisingly well contained everywhere else.
It really was. Japan's Nikkei index fell just 0.44%. Hong Kong's Hang Seng actually managed to rise 0.16%. And Europe's Stoxx 600 was basically flat for the day, as the big gains in European energy companies offset the pain in their technology sector. Even the crypto markets were relatively calm, with Bitcoin actually up slightly today.
We also saw the Bank of Korea step in quickly, signaling a rate hike for later this week and moving to heavily regulate the leveraged ETFs that were at the very center of this blowup.
So far, this looks like a very isolated, Korea-specific leverage event. The firewalls held up nicely in Japan and Europe, but when you're dealing with global margin calls, you always have to watch carefully for the delayed second-order effects, so it remains the key thing to monitor this week.
Through all this incredible daily noise, it is vitally important to check on the long-term thematic stories. And the truth is, the core investment theses really held up well today. Power demand for AI data centers stayed incredibly strong.
Yeah, just look at Bloom Energy, one of the primary emergency power plays for data centers. It is up 12% over the last 3 months, and the big power producers caught a strong defensive bid today, keeping the utility sector firmly in the green. Industrial materials were also firm, with names in the rare earth space remaining up big for the year.
Even Cameco, which fell about 6% today, really just dropped on the exact same forced deleveraging we saw elsewhere and a compression of its Westinghouse premium, not on any actual break in its core business.
Exactly right. Real physical demand stayed intact across the board. The tape today was driven entirely by positioning and forced leverage unwinds, not by any changing fundamentals in energy, uranium, or AI infrastructure.
So stepping all the way back, what is the core narrative thread for today? It was really the leverage and liquidity tape showing its teeth.
You had a brutal Korean margin unwind, combined with an oil and Hormuz geopolitical shock, combined with a hawkish inflation setup. And all of that bad news landed squarely on the single most crowded, most heavily leveraged trade in the entire world: memory and semiconductors.
Meanwhile, the underlying business demand, like Taiwan Semiconductor, sales up 36% and SK Hynix profits up over 5-fold, stayed completely and visibly intact.
The big picture read here is that this looks like excessive positioning being flushed out of the system, not fundamental business models breaking down. But again, a heavily leveraged market is an inherently fragile one. And fragility is exactly why days like today can turn so violent so fast. We have to respect that fragility going forward.
The next 24 to 72 hours are absolutely loaded with market-moving events. The CPI inflation report lands tomorrow morning, and that is the ultimate swing factor for everything we talked about today.
A hot core inflation reading would completely supercharge the rate hike repricing we saw today, and it would pile even more heavy pressure on semiconductors and gold. On top of that, major bank earnings begin with JP Morgan, Goldman Sachs, Bank of America, Citi, and Wells Fargo all reporting. That will give us the real, unfiltered read on the health of the consumer and the credit cycle.
We also have Federal Reserve Chair Warsh testifying to Congress, which is another massive hawkish risk event. And the semiconductor bellwethers start reporting. AEHR tomorrow, ASML on Wednesday, and Taiwan Semiconductor on Thursday.
It is a massive, intense gauntlet of data. The absolutely smart move right now is simply to let this gauntlet clear before drawing any major sweeping conclusions. There is far too much event risk packed into the next 3 days to try and be a hero.
So the one line to remember for today: an orderly-looking index masked a violent, leverage-driven unwind. The crowded chip trade got flushed hard, while the actual underlying demand stayed firmly intact.
The big question now is whether tomorrow's CPI data calms this chaotic tape down, or pours even more fuel directly onto the fire.
We will be right here to break it all down for you tomorrow. As always, these are just the levels and trends we are watching. Please do your own research, and remember, this is not financial advice. Catch you next time.
Take care, everyone.
That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.